The financial system isn't overheating, it's transforming. One minute the headlines tell you everything is fine, markets up, confidence strong, soft landing, whispers everywhere. The next minute the numbers tell a different story. US markets valued at more than 200% of GDP, a level so extreme it doesn't signal optimism, it signals detachment. And CAPE suggests stocks are priced around 110% above the long-term average, meaning investors are paying double for the same underlying reality. Here's the paradox. The system looks stable precisely because it's being held up by belief, not fundamentals. And when belief becomes the main asset, the real risk isn't a crash you can see coming. The real risk is the moment confidence stops behaving like a safety net and starts behaving like a trapdoor. Because this story isn't just about charts. It's about your cost of living, your purchasing power, your ability to plan, and whether the rules of money you grew up with are quietly being rewritten. But here's the part nobody is saying out loud. The most powerful shift isn't happening on trading floors. It's happening inside the plumbing of global money. And once you see the mechanism, you can't unsee it. Right now, the system is running on dopamine, and the withdrawal is already scheduled. The core event isn't just too much debt or stocks too high. It's the convergence of two forces that don't normally collide at this scale: a hyper-valued market floating above the real economy, and a government debt machine that is mathematically cornered. US public debt has crossed $37 trillion, and the country is paying more than $1.2 trillion a year just in interest, more than the defense budget and over half of total federal revenue. That's not a policy problem, that's a structural problem. Because once interest becomes that large, the government isn't just spending a lot, it's feeding the debt with more debt, borrowing to service borrowing. And at the same time, the central bank is stuck in a trap: keep rates high, and the interest bill explodes, lower rates too fast, and inflation starts running wild again. Now watch how fast this escalates. When a superpower's entire financial credibility depends on non-stop refinancing, the question stops being can they pay? The question becomes, what will they sacrifice to avoid admitting they can't? And here's the trigger that reframes everything. What if the United States isn't trying to solve the debt problem, but to escape it by changing what money itself means? If the first warning was valuations, the second is debt. But the third, this one is the weapon, and it explains how the system survived this long. The US doesn't just manage inflation at home, it exports it. When America expands its money supply, like increasing M2 by roughly 40% between 2020 and 22, it doesn't absorb the full shock immediately. The overflow leaks into the global system through trade deficits, reserves, and dollar demand. That's the mechanism. The US can print currency, send it into the world, and receive real goods, labor, and resources in exchange. It's a kind of invisible tax paid by anyone holding dollars or depending on dollar price trade. It's quiet, it's legal, and it's brutal. Here's why that detail changes everything. If your currency is global, inflation isn't just a domestic headache, it's a geopolitical tool. You can fund wars, bailouts, and deficits with paper that the world treats like value. Notice what they didn't deny. They didn't deny the money expansion. They didn't deny the inflation peak, which hit about 8% in 2022, highest in roughly 40 years. They just shifted the framing to make it sound temporary. But once that export engine falters, everything in the system becomes unstable, because then the inflation doesn't leave the country. It comes home. Now watch the story flip, because this is where history stops being a lesson and starts being a warning. The dollar's dominance wasn't natural. It was built. In 1944, Bretton Woods anchored the world to the dollar through gold. Then in 1971, that anchor snapped when the US ended the gold standard, turning the dollar into pure fiat money backed mainly by belief. So how do you keep belief alive after you remove the anchor? You build a new one, and the system did, the petrodollar. The world needed energy. Energy was priced in dollars, so the world needed dollars. Here's the precedent, without the textbook tone. Empires don't collapse when they run out of weapons. They collapse when they run out of trust. And financial empires collapse even more quietly because people keep using the currency until the moment they don't. The British pound once ran the world until war, debt, and exhaustion made it impossible to maintain. The transition wasn't announced with sirens. It happened through years of stress that suddenly snapped into a new normal. But here's the part nobody wants to admit while the music is still playing. The United States isn't the factory floor of the world anymore. When production power shifts away, maintaining currency dominance becomes harder because the currency is no longer attached to the same real-world leverage. And once currency dominance becomes habit instead of necessity, it becomes breakable. Here's the proof hit that changes the tone from theory to action. In 2022, the US froze more than $300 billion in Russian foreign exchange reserves. That wasn't just punishment. That was a signal to every country on earth. Your reserves are only yours until they aren't. That single move quietly shattered the illusion of neutral money, because reserve currency status is built on one promise: safety. And once the world realizes safety is conditional, the next step isn't anger, it's planning. China reduced its holdings of US treasuries from over $1.3 trillion to around $770 billion, the lowest level in roughly 15 years. And alternative payment systems are accelerating. China's CIPS, Russia's SPFS, built to root around SWIFT. The contradiction is stunning. The US weaponized the system to show power, and in doing so, taught the world how to exit the system. Notice what's missing from the public conversation. People debate politics, they debate who started what, but the financial side, the part that actually rewrites incentives, is barely discussed. Because once countries treat the dollar as a geopolitical risk, demand doesn't collapse overnight. It leaks, it drains, and that slow drain is what breaks empires, because it forces them to pay more to sustain the same power. And that's where the next actor enters, a new bloc, assembling itself like a counterweight. This is where the pressure starts stacking into something bigger than the US versus one rival. It becomes a system versus a replacement. BRICS, Brazil, Russia, India, China, South Africa, and expanded members like Saudi Arabia, Iran, and the UAE represent more than 40% of global output by purchasing power parity, overtaking the G7 in that measure. And the goal isn't secret. The goal is to build a trade and settlement system that doesn't require the dollar. BRICS pay, bilateral trade in local currencies, mechanisms designed to reduce dependency on US financial rails. Here's why that detail changes everything. The dollar survives because it sits in the middle of global trade. If large economies begin exchanging energy, commodities, and goods without it, the dollar stops being mandatory. Russia and China have already shifted much of their bilateral trade into local currencies. And BRICS members control critical resources, energy production capacity, raw materials, and huge labor markets. Now watch how fast this escalates. The biggest threat to a reserve currency isn't a headline crisis. It's a successful alternative that works quietly, transaction by transaction. Because if you remove forced demand, the currency has to compete. And fiat money doesn't compete with resources. It competes with trust. And trust is exactly what central banks are buying insurance against. Now the human story turns into a strategic one, and it's written in one metal. Central banks have purchased over 1,000 tons of gold per year for 4 consecutive years, with China and Russia among the leading buyers. This isn't a retail frenzy, this is state-level preparation. Because gold is neutral, it has no counterparty risk, it can't be printed, and it can't be frozen by a sanction. Here's the unsettling implication. When central banks hoard gold at record scale, they aren't betting on a strong dollar forever. They're positioning for a world where credibility is fractured and hard settlement matters again. And some analysts have floated scenarios where gold could be revalued dramatically, $10,000 to $20,000 per ounce, as part of a balance sheet reset. That's not a prediction, it's a warning sign that people are gaming out endgame math. Because if debt is too large to pay honestly, systems don't politely default. They redesign the rules. They change the measuring stick. Now watch the bigger shift. If gold rises because trust falls, that isn't just an investment story. That's a signal of what governments fear most, a future where paper promises stop being enough. And that's when private capital starts moving too quietly, strategically, and ahead of the crowd. This is where the mechanism becomes undeniable. It's not just nations pulling away. It's corporations and smart money changing their behavior before the public notices. Major Chinese tech firms like Tencent and Baidu have shifted away from borrowing in US dollars and toward issuing yuan-denominated panda bonds. And offshore yuan bond issuance reportedly tripled from 2021 to 24, reaching close to $200 billion. Why? Two hard drivers: cheaper capital and currency expectations. Borrowing in yuan can mean interest around 2.1%, compared to roughly 4-5% in dollars. That's not ideology, that's math. Notice what this implies. If major companies believe the dollar will weaken over time, dollar debt becomes a risk. If they believe the yuan strengthens, yuan debt becomes an advantage. That shift isn't a press release, it's a positioning strategy. And from 2025, foreign investment flows into Chinese bonds and stocks turn positive again after outflows. Whether that trend grows or fades, the signal is real. Capital is searching for alternatives to an overpriced US market. Now watch how the story flips again. When corporations start moving away from dollar dependence, it's not because collapse is guaranteed, it's because optionality is priceless during system transitions. And the closer we get to a world where the dollar is one currency among many, the more internal fractures matter. And America has those too. Now we move inside the United States, because the most dangerous cracks are often domestic, not foreign. At least 7 US states have passed laws recognizing gold and silver as legal tender. That's not normal behavior for a country that supposedly trusts its own currency without question. That's a signal of internal doubt, a quiet hedge against inflation, a local-level insurance policy against monetary mismanagement. And at the same time, national politics has turned debt into a weapon. Debt ceiling fights aren't debates about discipline anymore. They're power struggles that flirt with shutdowns and technical default risk. Here's what that does to confidence. Creditors don't just watch the debt number. They watch governance. They watch whether the system can coordinate. And if the system can't coordinate, the safest borrower starts to look less safe, not because it lacks money, but because it lacks agreement. Now watch how fast this escalates. Even if the US never formally defaults, repeated political dysfunction forces investors to demand higher yields. Higher yields raise the interest bill. Higher interest bills deepen the trap. And once that loop strengthens, the US doesn't just risk a fiscal crisis, it risks a credibility crisis. And credibility is the true reserve currency, because the final pillar of credibility has a name, and it's built on oil. And now we arrive at the hinge point, the pillar that held the system up for 50 years. The petrodollar is weakening. Saudi Arabia, the keystone of that system, has openly discussed selling oil in yuan and joining BRICS. If that shift fully locks in, it changes the structure of global demand for dollars. Because here's what petrodollar did. Oil exporters earned dollars, then recycled those dollars back into US treasuries. That created natural demand for American debt and kept borrowing costs lower. If oil trade begins flowing into other currencies, those surplus dollars don't have to come back into treasuries. They can flow into gold, infrastructure, non-dollar assets, alternative systems. Now watch how fast this escalates. If the US loses forced demand, it must compete for buyers of its debt. That means higher rates. Higher rates mean a bigger interest bill, and a bigger interest bill forces even more borrowing, which pulls us back into the core mechanism you saw earlier, borrowing to service borrowing. Here's the final insight. The collapse of petrodollar doesn't end America. It ends the discount America has been living on, the invisible subsidy of global demand. And once that subsidy fades, the system doesn't just wobble, it rewrites itself. Because the next move isn't just a crisis, it's a reset, controlled or not. So the real story isn't, will the dollar die? It's this: power is shifting from paper promises to real assets, real production, and real leverage, and the transfer is already underway.